Hey guys, thanks for having me. So let's see. I guess just like show of hands so that I can kind of like tailor the talk. How many of you are like super new to like startups and fundraising and like don't know much about it? Okay, cool. How many of you kind of know a little bit about like angel investors, venture capitalists? Okay, cool. Okay, perfect. Okay, so what I would love to do is like I'm gonna talk for a little bit, and then we'll make it interactive because I feel like it's mostly helpful when it's like Q&A style. I actually used to teach at NYU like a while ago. I taught undergraduate computer science class, and I know for a fact that if I talk for a long time, people fall asleep. So I've learned from my mistakes, and so I try to talk less. But so super high level, like 5-minute crash course in all of this madness. So number one, it's super tricky and complicated. It will require more than 5 minutes to understand all of it. Secondly, when you start a company, you typically require capital to get the company over the ground, right? Because you need to get paid, you need to acquire customers, like you need a little bit of money typically to get the company going. So when you need capital, you have kind of like various sources of getting capital. One could be your customers, which is amazing and long forgotten, meaning you can actually go and sell something, maybe something that you don't even have yet, and kind of get a customer. That's called bootstrapping. So that could be one source of capital. Another source of capital could be your own savings. That's pretty scary. Most founders don't have a ton of savings, but you can kind of like, some people have massive conviction around their business and they would put their own money in. Some people go to their friends and family. Okay, typically when you either put your own money in or you go to friends and family, you're probably not going to raise a ton of capital unless you're already loaded, which is a good problem to have, or unless your family is loaded, which is also a good problem to have. Yeah, Snapchat guy was, he was well off to begin with, which is interesting because he got screwed in his Series A anyway, but we can talk about that separately.
But yeah, the family, that's good.
Yeah, the family was well off. So basically, typically when you raise when you raise from friends and family, it's typically called pre-seed. It's probably not a ton of capital. People call pre-seed anything between, I would say in New York would be like anything between 50 to up to 300K. That's what I would call a pre-seed. So real quick, when you raise from friends and family, it could be great or it could be bad. The way that it's great is because it's people who already know you, they trust you, they could give you money. That's cool. The way that it could be awkward is then at the Thanksgiving dinner, people are staring at you because you're that person who took the 25K check. So, you kind of need to sort of think about it.
Choose your friend carefully.
I mean, like so the other thing you'll learn is everything depends, which is not a great answer. So like depending on your situation, it may be a good option or not. So. Beyond friends and family, you can raise money from people who are called angel investors. And there's two types of them. There's professional angel investors and occasional or wannabe angel investors. So angel investors who are occasional typically only would invest in two types of founders. Either they know someone, and that's like really common in Silicon Valley. People would say, I only invest in people that I already know, like people who I worked with before or somebody, like somebody they trust. The kind of like the big theme here is like people know you, right? So like whether it's friends or family or angels who are occasional, like they would only invest in founders they already know. Why? Because early stage is like the riskiest and like most of the startups like die. But if you invest in somebody who you already know, you're not really investing in the startup, you're investing in people. And so it's a form of de-risking. You can also, so occasional angels invest either in people that they know or they would invest in the industry that they really know about. So somebody who is like an expert in e-commerce or media can say, I'm gonna write maybe like 2 to 3 25K checks a year to kind of like, founders that I'll find. If I don't find any of them, like I'm cool with that. Like, so they're not like really, they're not methodical or deliberate. They're just kind of like, I would invest in somebody like from the industry that I know. Then really most of the angel investment capital, especially in New York, comes from what I would call professional angel investors. Professional angel investors, some of them could be called like micro VCs, but long story short, they either manage their own money or they manage somebody else's money, but they do it in a professional manner. So what that means specifically is they would have some kind of pacing to their investments. So they would say, I'm going to make like 4 investments a year or 6 investments a year, and I have specific check size. So I either invest like 50K or up to 100K. The thing, kind of the analogy that you should have in mind, once you kind of walk up the ladder of professionalized investors, it's all about risk management. They don't necessarily care about any given startup, your startup. They care about a basket of startups, because really you can't you can't really think about any single investment because it's completely like unpredictable. It's really hard to invest. There's really no data. So when they kind of invest, they think about basket of investments, and that's why pacing is really important. So when you think about angel investors or VCs that we'll talk about in a minute, they have typically certain pacing. So example, an angel investor may say, I'm going to make 6 investments a year, and they would tend to make them kind of splice through the year. So that means they would write like 1 check every maybe 2 months. The person wouldn't make all like investments like back to back. Why? Because people also try to kind of amortize the investments over time to make sure that they don't miss like something interesting. And so this notion of pacing is pretty important for like when you kind of bump into professional investors. There's lots of tips and tricks that I'm not going to go into unless you guys get to like Q&A on this, but just know that when you meet them, it's really important to ask like what their purpose of investing in, and like how do they actually invest, how many investments they make, what their check size is. In general, to be successful at fundraising, you need to figure out who are the right investors and why, what would be their motivation, so that you kind of don't waste time going to wrong people. You guys with me so far? So we kind of talked about bootstrapping, getting money from customers. We talked about like pre-seed with friends and family. We talked about like getting money from angel investors. So in New York specifically, angel checks range anywhere from 25 to 50K. From 25K to 100K. So the other option, go ahead.
How do you find angel investors?
Well, that's kind of tricky sometimes, right? But like your first stop could be like Angel List, or you could simply Google. Like for example, if you Google top angels, in New York, you're gonna get a bunch of articles, and so you will see those people. You should talk to your friends. You should talk to people who already like raised capital, but really, like it's work. Like you have to do the work to kind of like figure out which angel investors are right for you. So in addition to, so when you working, so I said that the angel check in New York City is anywhere between 25K to 100K. A typical seed round, I would say, is anywhere from 500K to maybe north of 2 million. So if you're raising $2 million, it requires a lot of angel checks to like, if you think about like raising $2 million in 25K chunks, you probably die in the process. It's very painful. So nobody really does that. So what do people do? It's actually a pretty simple strategy that we cover when we take companies like through fundraising in Techstars. But visualize kind of like an inverted cone, and that's your round. So on the bottom of the round, you start with very small checks. So anybody who is willing to give you 10K, 25K, you kind of keep taking those checks, and so you fill the bottom of the cone with like small peoples, right? Then as soon as you get to like a third of the round or some decent amount, like first 200K, you now start going after bigger checks. Now you want people to give you 50K, 100K, etc. And then you keep filling up the bottom. Now that you've got, maybe like a half of your round filled out, you now want to go after people who are called micro VCs. So micro VCs would be like a smaller size professionalized venture capital funds that typically range anywhere between 10 million to up to 100 million is what I would call a micro VC. Yes. These days, they used to be like 100 used to be like big. Now I would like bucket into a micro VC. So those investors can give you checks anywhere from like 250K up to probably like $1 million realistically. So when you kind of like if you're trying to raise a large seed round, at the end of the round, you want to have, you want to start talking to like larger checks because you kind of want to complete the round with a larger check. Micro VCs behave, so big difference between micro VCs and angels is that micro VCs do a lot more research and they're a lot more professionalized than angels. So most angel investors would do some digging on your space and like what you're doing, but they would mostly invest on the gut. So they would be just like, I've met you 3 times, you sound amazing, you're very smart, I've asked you all the questions, you've answered all my questions, here's the check, right? Micro VCs don't do that. They do a lot more work on kind of like, their process is typically longer. They typically have a fund set up. It's not a one person, it's multiple people who are managing money. So they kind of, several people have to agree to invest. And they typically do a lot more diligence on your competitors, on your go-to-market, on your metrics. And because they give you larger check, the risk is higher. Like you can't just meet somebody and give them 250K check. That's pretty unreasonable. You need to kind of spend time, really understanding like the business and making sure that like, you're not just gonna immediately lose 250K or like a larger check. You with me? Making sense? Mm-hmm. Okay, cool. Okay, so basically the process with micro VCs typically involves, like I would say recently in New York, at least 4 to 6 meetings. And they sort of ask different things. Most founders are out on the first meeting just because they don't have enough traction. And micro VCs specifically want to kind of see that you're able to sell, that you have some kind of growth. If you kind of get past the first meeting, they probably would dig in much deeper on your competitive landscape, on like who else is doing it, what is your growth trajectory, like how are you planning to acquire customers, like, and the other really big thing for like micro VCs is how big is your market. So this is there's like a pretty big difference between different types of investors. As an example, an angel investor would be perfectly happy investing 25K into a company that would raise $1 million and then 3 years later exit for 30 million. That would be an amazing angel investment. The bigger the size of the venture fund, the less happy they would be with this outcome. And so this is a really, really important thing, so pay a lot of attention. This is like the simplest trick about venture capital that most founders miss. Most founders just look at the universe from their perspective, but you really need to understand the universe from the investor's perspective. If I'm an angel investor and I can, have a company that raised 25K for me and then returned, 5-7x within like 2-3 years, that's an amazing outcome. If I have a very large fund, if I have a large venture fund, let's say $150 million fund, okay? The only way I make money as a venture capitalist is if I first return entire $150 million to my investors, and after that, I have to make even more money, and then I get paid 20%, which is called a carry. So specifically, and this is like a super important point, like venture capitalists have salaries that are fairly small, and they make all their money on the returns, and they don't make any money until entire fund is returned. So basically, venture capital funds consist of what's called limited partners and general partners. Limited partners are just people who invest capital, right? And then general partners are the ones who manage the money. So general partners don't make any significant money until the fund is fully returned. Then, once the fund is fully returned, they start making carry, which is typically industry standard is like 20%. So if you guys think about this and start doing the math, you will realize that venture capitalists are one of the most glorified celebrities on the planet who basically never make any money, or sometimes maybe few of them make money, but like a lot of them just can't make money because it's super, super hard. So let's do the math. Let's say I'm managing $150 million fund, right? So let's say I have a company that's $1 billion company, right? Not a lot of those, but let's say I'm a lucky guy and I invested in $1 billion company. And let's say the company is sold for $1 billion. And let's say I own 10% of that company. That's astronomical amount, right?
Not enough.
How much do I make?
Just 100.
It's only $100 million. I only get $100 million, right? But my fund is $150 million. So there's still $50 million that I have to return before I can get paid. You guys with me? Mm-hmm. So I actually have to sell 2 companies for $1 billion in order, I have to sell like a company for $1.5 billion in order for me to, if I own 10% at the finish line, to return the fund. So the point being is that's why the larger the size of the fund, the more capital they want to invest, the more ownership they want to have in your company, the more they care about being able to follow on when you raise capital, and the more aggressive they get, the bigger sort of like your company gets, because it's really, really, really hard for them to make money. Most of their investments go to zero. That's why the whole thing is like super crazy and like counterintuitive. Okay, so this is kind of like super high level. You get kind of like from taking money from the customers to like putting your own savings, friends and family. You have angel investors who kind of like mostly operate in the seed space. Then you kind of have micro VCs that play in both seed financings and Series A's, and then you get these larger funds, which I would now call like venture capital funds, and they range in size from like Union Square Ventures is $150 or $175 million fund to all the way like Andreessen Horowitz is like $1.5 billion under management. So when you think about $1.5 billion under management, Andreessen Horowitz needs to have a lot of unicorns in order for them to in order for them to make any money. How are we doing so far? Is this making sense? Is this fun?
Yeah.
All right. If you guys are interested, so I've written like a ton on this topic. I'm actually like planning to publish a book. It's just been delayed because I'm super busy. But if you go to alexiskold.net, yeah, Alex Iskold, ALEXISKOLD.net, and you will click on fundraising. There's probably like 30 different articles on the topic, and I kind of try to slice and dice it from different directions. So with that, why don't we switch to the Q&A format? Because I feel like this way you guys get to not fall asleep, and I get to answer the questions that you actually want me to answer. Yeah.
About the crowdfunding.
Great question. So there's also an opportunity to do crowdfunding, which is sort of like, there's different forms. So let's kind of walk through it. There's Kickstarter, there's AngelList, which is not a thing anymore, but we can talk about it. And there's Indiegogo. So let's kind of break it down. So Kickstarter could potentially, like, used to be like a really good way. However, it's not really a form of raising capital. It's more getting people to pre-buy your product. So really it falls more into like the first category. So let's say I came up with the idea for like how to create better bottles. I create a Kickstarter and like an amazing video where I am all about how amazing these bottles are, and then I pop it on Kickstarter and I call a few friends who work at Kickstarter and I'm like, hey, can you feature me on your homepage? They're like, sure. So, and then I get all my followers to tweet and Facebook, and hopefully a lot of you are very interested in these bottles because they're amazing. So then you go and you kind of like start pre-ordering them. And that way I kind of get capital to do what? To manufacture the bottles. So the challenge with Kickstarter, so first of all, I think it's a great way to kind of validate the demand. The challenge with Kickstarter is a lot of founders who kind of like put the stuff on Kickstarter then are unable to manufacture because manufacturing is like pretty hard. But it certainly is an option, and there's like a bunch of things that were like pretty successful. I feel like it's only good for mostly like hardware products. I mean, I wouldn't do it for like a software company. Yeah.
I in fact checked into this idea of, I checked with Indiegogo, but it doesn't matter. It's the same
Yeah.
idea. What I understood after checking and asking around a lot is that first you have to invest in marketing, which is
Right.
at least $50,000.
Right.
Which I don't have.
Right.
And I said, thank you very much. I don't think I'm going to go there.
Well, I mean, we still live in a free universe for foreseeable 15 seconds. So like everyone can make their choice. But you know, look, think about it this way.
It's not without cost.
Well, life is hard. There's physics, you know. Like I don't know.
I didn't say that. I'm just saying it's not like, okay, I just make a video and ask for people to come.
You don't have to. I don't believe you have to invest in necessarily 50K into marketing. I think that what's happened is this. Look, any new platform like Kickstarter or Indiegogo or App Store, right, goes through novelty and saturation phase. Mm-hmm. So when you think about like when Kickstarter just started, it was a novelty. So a lot of people were like really enthusiastic, like jumping in, and you could kind of get a lot out of it. Now it's a lot more noisy, right? There's a lot more competition. Just like in the App Store in the early days, or like, you know, Facebook platform, if you guys remember that thing, like you could just get a lot of downloads in the early days, but now it's like really saturated, no one can discover you. So the same thing is happening, but I feel like it boils down to like if your product is really amazing, and if you shoot like a simple video and you put it on YouTube or Kickstarter, like if it's really good, people are gonna like share it and tweet it, and I feel like you can get a lot of attention. Even look, amazing ideas and great products still sell, and like I feel like people are comfortable with the concept of pre-ordering, even though like a lot of these campaigns just like never even fulfill. So let's talk about AngelList briefly. So the idea behind AngelList initially was to basically democratize angel investing. So the idea is that like angel investing historically has been a very personal and physical activity, meaning angels in New York City until today aren't really comfortable investing in like startups in LA, because why? They've never met you. It's the what I call human smell test. Like we're still in the world where we're physical beings, and I want to shake your hand and really talk to you and look you in the eye because I'm about to give you a check, so I want to know if you're for real or you're just going to take the check and I will never see any money back. So historically, fundraising online, it wasn't really a thing. So AngelList was like set up to change that and to kind of be able to connect, you know, angels from LA to startups in New York. And so, like long story short, I don't think that it's a super successful kind of booming thing. As it turns out, I feel like, you know, angel investors still prefer to basically like spend time with the founder. But right now, AngelList has this different kinds of like syndicates that seem to be working for some kinds of companies. So the most typical use case for AngelList is if you raise money from a super angel, which is basically a highly influential angel investor that everybody knows about. Like for example, Jason Calacanis, super famous guy, lives in San Francisco. If he invests in you, then what he does is he syndicates this deal to his followers and AngelList. So the idea is Jason himself is going to invest $50,000. However, a group of his followers, because Jason is investing, can get really excited and they all will throw in 10K, 25K, 30K, and suddenly you have 500K that may be invested through the syndicate. And so that still kind of works. And then sometimes people also use AngelList for, you will hear, this is actually now on the rise, and you may hear this in New York because there's a bunch of these that are happening. AngelList now facilitates private funds and private syndicates. So the idea behind it is kind of interesting. So imagine that there's like a group of people that wants to invest together. It could be a group of friends, it could be a group of founders that have had meaningful exits and they want to invest together. They can create a specific syndicate on AngelList that's only private to them, that only they see, that can invest in your company. And the cool thing about it is it's set up as an LLC and they just invest into this one company and that's it. So there's like a different investment vehicle per investment. So without boring you with details, it's mechanically cool and it's tax advantageous. And like these things are like fairly popular. So you may hear something like on the streets, if somebody wants to invest in you, they'll be like, okay, I'm gonna be in, and I also have like 5 of my friends that I co-invest with, and we have, SPV on AngelList. So special purpose vehicle, you may hear that, and so just know that that means like that they have like a private fund. I feel like that's all I have to say on crowdfunding. Yeah, go ahead.
What's the extent of the liability? Are we personally liable for the funding?
Great question.
The business
So the short answer is no if you set it up properly. So like most common structure to create a company is an Inc. So you would hear a lot of people say like we created like a Delaware Inc. or Delaware Corp. Basically the point of that structure is that it has protection it affords you protection under law because it represents a legal entity. So in a human speak, you and I are like legal entities, we could be sued. In order for a company to not have individual liability for officers and employees, that's why you kind of set up an Inc. and an Inc. becomes a legal entity. So as long as you're like an Inc., you say it again? Yes, or LLC, and I'll get to this in a second. I didn't want to throw it in the mix because it's going to confuse people. Well, you really shouldn't be setting up LLCs because LLCs are not the vehicles into which angels or VCs are comfortable investing, because by law, LLCs cannot have more than 99 shareholders. So by the time you get huge and want to go public, you can't do that with LLCs. So therefore, venture capitalists never invest in LLCs. You actually have to be set up as an Inc. in order to get an investment. However, one more thing on this topic, you actually still can get sued if you're a director of a company. And that's why there is additional insurance called like D&O, which I forgot what the heck it stands for, but the D is for directors and operators probably. It's typically like 10 to 30K, so you get an additional insurance in order to get sued. Now, I know I've scared you, you look very scared, but you shouldn't be scared because there's basically, unless you're doing something insane, which if you do, then I want to hear about it, but there's like basically no chance that you're going to be sued by anybody anytime soon, and also there's a virtual 100% chance that you're going to be sued as a company by everybody once you get big, which is why like Airbnb and Facebook and Netflix get sued daily.
And Uber.
Say it again?
Uber right now.
Uber, yeah.
How about if you incorporate as a B Corp?
Yes.
Are like VCs and angel investors like less comfortable with that versus like a C Corp?
No longer. They're fine, right? So Etsy went public and it's a B Corp. So for those of you, how many people know what B Corps are? Okay, so B Corps are basically like corporations that also have public good in mind. So they're like the don't be evil embedded in their DNA. Long story short, it's a lot more paperwork and a lot more reporting, but VCs are not really averse to investing in B Corps. It's just more work. Yeah. Yeah. Yeah.
I'm building software as a service, and it gets really kind of difficult to earn traction before I get the angel investment. So in those kind of cases, how do you make a product, or how do you generate traction as a starting software as a service?
So I feel like you asked me two questions. How do you make a product, and then how do you get traction? So let's see. So there's like a few. So the question was, like, how do I, like, it's a chicken egg problem. In order to make a product, I need to get some investment, and like they're telling me to get investment, I need to have traction. But if I don't have a product, I can't get traction. That's actually not true, because you can actually pre-sell your product, and that's actually what investors want you to do. In fact, better companies start with 0 lines of code, right? Like, better companies start with like the customers, and in a way, I mean, think about this. On Kickstarter, people are selling these random bottles every day. People are buying completely random crap, and they're willing to like prepay for it. And like, why can't you go take your idea to your first, second, third, fifth customer and get what's called letter of intent? So the way you do it is you say, hey, I'm going to build this piece of software. It's going to be awesome. It's going to solve all your problems. Now, assuming that I build this piece of software, would you be interested in talking about buying it? I didn't say buy it. I didn't say give me money yet. I said, would you be interested in buying this piece of software? So let's say the customer is like, yes, I would be. And then you say, okay, would you mind signing this completely non-binding, super vanilla, very simple one-pager that says that awesome company, blah, 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 would consider buying software from an amazing founder, your name, if he builds it and not even any price? So that's called a non-binding letter of intent, and it's pretty great, because now when you go to investors, not only you say, I've talked to potential customers, but you say to them, I have LOIs. And that's actually a really powerful statement, and there's different kinds of them. Obviously, people understand that this is a bit of a BS, so they'll check whether it's from your uncle or it's from a real person. But the point being is, given enough of these LOIs, investors will agree to probably give you money, because it's less risky. Because then the question is going to be like, okay, can he build it? What the price is going to be? But it's a lot more concrete. So it's not just an abstract concept. So you always should try to start with, trying to get letters of intent from your prospective customers. Then you can go to investors. Like, realistically, it's really, really hard to get an angel investment if you're a first-time founder. You should also either put a little bit of your money in, or friends and family. Angel investors would expect you to do that. Now, another way you can do it, which is the way that I started 2 of my companies, is I did this in the evening and weekend, and I didn't go and enjoy the beautiful outdoors, but I just grinded in the basement. So the way you do it is, like, you come home from work and you just kind of spend your personal time writing code. And there is no reason why you can't do that. So obviously that takes a lot longer, because you're not working on this full time, but you can build a product. In this day and age, you can actually build a product fairly quickly, because there's so many tools that exist. So you can kind of like prototype and stitch stuff together fairly quickly. I personally think you should be doing both, right? You should be actively talking to your customers, securing LOIs, and you should be actively writing code. Now, there is something magical, give me a sec, about writing code, because, and you guys should check it out, I just wrote like a massive blog post about this. One of the best ways for you to convince investors is to show them a killer demo. Because if you just talk about how amazing it's going to be, no one is going to kind of like understand or believe you. But if you start showing them what you've built, that's what's going to get them really excited. So now look, you're a first-time founder, don't have a ton of experience, but here's what you do have. Not only you've talked to customers, but you now have 5, 10 letters of intent, and check out this killer product that I built. And I got like a little bit of capital from my friends and family Now the story actually start to add up, and if you think about this for potential angels, you just reduced a lot of risk. If you're a totally blank slate, can't get any money, can't get any customers, can't write a line of code, people are like, well, you know, you haven't taken enough risk, you haven't done enough. Like, I don't believe you can do it. But if you've done all these things, you're like this much closer to like real business, and so that's when they're like willing to invest. Yeah.
Well, I'll follow up to what you're saying and also something that relates to that, because you mentioned it in
Yep.
your answer. One is that I think that when you said the letter of intent is if you are B2B, but what if you are B2C? Any letter of intent from
Well, if you're B2C, you have to build the product and launch it and get traction. B2C,
Right.
I mean, B2C is pretty hard,
Yeah.
right?
So,
But like your letter of intent comes in the form of users' attention,
okay.
right? Like
So-
how many people downloaded your product? How many people?
Even if it's free at the first stage,
Yeah,
just put it for free, it's still traction
Right.
is traction, even if they
traction
don't get
is
like-
traction.
No, no. What I mean is that, that's what most startups do, they
Right.
they provide for free. I mean, that's, that.
Well, it entirely depends on the business. What was your question?
It was kind of similar. Like if you're building a platform that's for connecting people around a certain need,
Yeah.
but not so much buying something, does letter of intent still apply?
You're like in the Mission Impossible quadrant. So I need to issue like several advanced warnings. So let's talk about the massive elephant in the room that nobody wants to bring up. So there is a big myth about like first-time founders. Nobody wants to fund them. Like they're lying to you. That's not what they're saying. A lot of times people say stuff to you, but they actually mean totally different thing. So here's what actually people are telling you. You have no experience in this market. That's what they're actually telling you. So the reason that people, so when you think about something that you want to build something consumer, and I did that. That was so like not a good idea, but like I did it anyway. Like when you're doing something like this, you have to realize that it's super saturated. It's not differentiated. You maybe probably first-time founder. And so in order for people to be convinced, I'm not saying don't do it. I'm just saying that the bar is so high. The expectations are so massive. So really, if you want to build a consumer product that doesn't monetize out of the gate, there's only one path. And the path is you put your savings, you get friends and family money, and you build the product. And not only that, you have to launch it, and it has to take off in a fairly massive way in order for anyone to even like take you seriously for 5 minutes. And I'm not kidding, because it's just like the riskiest of like all territories. People still do it, but you just kind of need to be aware of that. And there is really no way to kind of have founder market fit in the consumer space. Like, what does that even mean, right? Like, versus in the B2B, like, hey, I'm starting a security company. It takes care of spear phishing. Like, and I've previously founded 4 security companies. Okay, investors are immediately know that, like, at least I know what I'm talking about. So just kind of like keep that in mind. Yeah.
So I've been saying, but on that note, would you say that there are a group of investors that are looking to fund B2C businesses?
Of course. I mean, like, the question is if there are investors who are willing to fund B2C businesses, 100%, but they're willing to, they're looking for serial founders in spaces that they know, ideally with like, monetizable out of the gate. Look, great companies get funded. My point is, as a first-time founder in a B2C space where you don't have a product but just an idea, the chances of getting angel investment are like as close to nil as like they could possibly be. Yeah.
When you say like massive traction in a very short amount of time, like can you give an indication of how massive and how short time?
It depends. Everything depends, right? It's also like, do they like you? Do they like the space? But roughly, like, think of it this way. It's like anyone who looks at your chart should basically be like, okay, this is taking off. And so realistically, it means like N%, month-over-month growth, where N varies between at least 20 to like 40% across the key metric that people actually think matters, which increasingly isn't page views, but some kind of engagement that sort of like proves stickiness and can possibly lead to monetization. So a lot of founders have a big misconception about like consumer businesses, and like they fall short on just like reporting app downloads, app opens, page views. That's totally not the right way to think about it. And the misconception stems from Facebook. Because for Facebook, it turns out that it's not a bad thing for them to measure, because every page view gives them an ad view, and they monetize through ads. But if you ultimately don't monetize through ads, page views aren't relevant. And the other thing is that most consumer startups have some sort of gesture or like actually a right action that creates more stickiness. So if I'm just a passive viewer, I'm not as valuable like if I am a creator. So the answer to your question is actually really complicated and really depends on like, if you tell me exactly what you're doing, I'll tell you like, here's what people are gonna care about. Yeah.
So LOIs, would that work for hardware products too? Like if you're selling a hardware product B2B and then getting letters of intent,
Yes.
that would work? And then
Absolutely, yeah.
so you got the letter of intent, let's say you had like not the full product done, but let's say you had like a working prototype or something like that. Is that something you would go into to show them like what you're doing?
Yeah. Yeah, absolutely. Like, yeah, that would be great. Like, we just had a company that's gone through our winter program, and it's a company from Waterloo that invented new type of displays. It's like super hard to build, like 5 years to market. And then what they did was they went to Electric Objects, Mural, and other manufacturers of art frames, and talked about their technology and said, hey, like when we have it ready, once we build it, do you want to buy it? And they got like $5 million of LOIs. I mean, you know, it's basically, if you think about it, it sounds astronomical, but it's a complete non-give from the perspective of like potential buyer, because it's not binding, meaning like, you know, they can walk away from it anytime, but it's a good validation because that means that there's a potential demand. And the more of these kind of LOIs and like validation they can get, the more certain, because here's another thing you need to understand about investors. They're not polymath or experts in everything, right? So how do they validate? Like traction allows you to basically validate the idea is valid. I don't know how to debug this like crazy display. The guy invented new chemistry. What does it even mean, right? Like, and so, well, we debug them. We're actually like able to figure it out. But like the point is, when you show up with LOIs for your thing, that means the customers have done the diligence on you, and they were that happy that they were willing to actually write their name on a piece of paper and say, yep, that was pretty awesome. So it massively reduces risk for the investor. Yep.
So about risk for the investor, if we're thinking about, do we work on the startup full time and work on the side to support ourselves, then invest all of our personal money in the startup, versus raise money, pay ourselves salaries, and work on the startup full time? I feel like it's a catch-22 because investors want to see that you're fully invested in the startup, but they don't want to see that you're using the money to pay yourself.
You should give them a present. There's a book called Outliers that just came out last year, where they did study on like a bunch of famous founders, and guess what they found? What they found is that the biggest founders were the most uncertain ones. So they're not like the crazy ones which just kind of like quit everything and like all in, but it's the founders who were very doubtful. So it's kind of counterintuitive, because like the stereotypical founder is like the person who's like all in, that's it, I'm, you know, thank you very much, out the door. And but like, you know, a lot of the super successful founders actually took their time and were sort of like part-time initially. That is not going to be held against you. What's going to be held against you is your ability to deliver a prototype and get customers. So if you can get LOIs, customers, and build an impressive prototype, people ultimately won't care, but then they will kind of they will ask you to build a financial model. Now, you do need to address the following issue. If you're asking me for $25,000, okay, but in reality, in order for you to get to any meaningful milestone, you need $500,000. Then what I'm going to tell you is, look, I really like you, I like what you're working on, I will give you my $25,000, but not now. I will give you the $25,000 when other 20 people like me will agree to give you $25,000. So let's talk about that. When you're raising capital, people don't want to give you money right away. You want the money right away, but they don't want to give you money right away. And the reason for this is because it's too risky. If I'm one $25K check, but really to build a product, you need $500,000, I like you, but I can't give it to you because you'll just spend 25K. How do I know you're going to raise more money? That's why rounds typically close simultaneously. That's why you have this concept of soft commitment. So what you really say to me is you say, hey, Alex, okay, you're going to be part of my round. I'm going to write you down for $25,000 now, and then I'm hoping to close my round later. And that's when you go after a whole bunch of different people and try to line them all up. And that's when you kind of like email everybody and be like, hey, great news. We now have $500,000 lined up. I'm going to close the capital now because there's a group of us, because we probably all know each other, because New York City investment scene is one big cahoots. Like, you know, you basically can know that it's safe to close. Yeah. Go ahead.
So, just want to introduce myself because I'm a serial entrepreneur and experienced. I went to NYU and I'm alumni.
Yeah.
I have multiple restaurants.
Yes.
But I recently launched, it's only been 3 weeks, I recently launched a software. It's called TAGFI, T-A-G-F-I, and it stands for there's a group for it. And it is what you may not like, it's a B2C product.
Okay.
It's on iOS.
I like B2C products. I built a B2C company, it sucked, but yes.
No, but it's a wonderful product, and I would love if you guys check it out because what it is it's B2C and B2B. And so the way it works is it's to join and create group activities on the
Yeah.
fly, so sort of spontaneous meetup, but it ends with, it's so, I said an end-to-end solution because it recommends places near you that you could take your group and get a group.
Cool.
So
Awesome.
it is also for groups that you have already. It's not just for brand new group formation. So if you have group, you want to get a discount, you would just.
I like it. It's like a physical Groupon.
Yeah.
This is an example of good entrepreneurship. You have to have guts to parachute in the middle of all of this and pitch your thing. So learn, take lessons learned. What's the question?
So the reason I'm bringing this up is
Always be pitching.
to my application, but and my platform.
Yeah.
The reason is we only launched a couple of weeks ago.
Okay.
Getting good traction, and I don't know what good traction is in terms of.
Well, then how can you say that it's good?
Sorry.
I don't know. You said good traction, but then you said I don't know what's good.
Well, I don't know good in terms of relative to what. So I'm looking for funding right now. It's
Right.
Angel, sorry?
Say it again.
I'm looking for angel round funding.
Yes.
It's been all seeded by me and my.
Okay. Which part of it is a question?
So my question is, I know that the bigger thing is that angel funders look for sort of traction. And I'm wondering what is that traction they're looking for? Is there a certain number?
Well, look. So let's talk about traction. It's actually really simple. The best form of traction is growth of revenue. Okay, that's the best form of traction. That's what all investors look for. You're making money and it's growing. Like, that's amazing. That's what investors want to see. Okay, let's say you don't have that yet. So what's the next best thing? What do you think?
Growth of our users.
Okay, growth of users. Any other ideas?
Stickiness.
Take a cut of every sale.
Take a cut of every sale. What else? I'm setting you guys up. You already know that. Number of users. Okay, so here's the really important point. It is not number of users. It is whatever metric that will in the future allow you to make money. Because remember, startups, businesses, they're all about making money. If you can't make money right now, I am okay with that. But what I want to know is how you're going to make money later. So it may be that you'll be able to monetize each user, but how? Right? how exactly? Well, in your world, what's happening? In your world, how do you think you're going to get paid? I'm asking.
Just give me how much
Yeah.
I get paid. Well, the way I show it on my business plan is that we're getting, the whole platform is monetized by the businesses, by them, being the recommended places nearby, paying.
A business is going to pay you to be on your platform?
Exactly.
Okay, how many businesses are on your platform now?
Well, so we offered for them to be on for free in the first 6 months because we don't have enough users.
So
I do have a good, I would say, 100 contracts.
you have 100 contracts, so you have 100 businesses on your platform for free. Okay, then how much are you going to charge each business?
So right now, the way we have it is it's 100 now, but we projected about 2,000 for the end of the year, by the end of the year. But for the 100
Per business?
after the 6 months.
Per
yeah,
business?
2,000 businesses signing up. So
Okay.
the 6 months.
What do you guys
and
think?
this was all
What should constitute traction in this business? What do you think?
Conversion from like the free to paying business.
Conversion from free to paying business, but she doesn't have that yet. She's kind of giving it for free. That's definitely going to kick in once she starts monetizing. Go ahead.
Probably the number of users who actually go to a business activity.
Bingo. Because number of users, your key metric should be number of users who go to the venues because you're a lead gen business. If you're a lead gen business that generates no leads, you're not a business. So you have to generate leads. So therefore, not only you have to generate leads, you have to measure average number of leads per location, and it's better be going up. So it's not just how many users have your app, right? And that was exactly my point about misconception about users or page views. That's not how you make money. Sure, you make money per user, but that's not really true. You make money per users who go to venues, and actually you make money on the venues. So your whole KPI, your key metric, number one metric, should be weekly new users attending venues. So with that, how much traction do you have?
Well, that's the problem right now, because there's so little users in the same area that the restaurants, facilities, or whatever I have,
Yep.
the businesses that I have, it's very difficult to form that connection because you need a lot more users, and in order to get those users.
So therefore you don't have good traction,
It's
right?
nothing.
So
Yeah.
you don't have good traction.
Yeah.
You don't have good traction in terms of your business. What you do have traction with is signing up venues. So you signed up the venues. Okay, but now here's the problem. As an investor, I'm going to tell you the following. Signing up venues is the easy part. Why? Because there's no downside for venue. You're like, hey, do you want to bring me users? Okay, sure, I'm a bar. Bring me people who drink. I'll take it, right? But now you have to really figure out how to get users. And in this chapter, we discover that it's actually really hard to get like people to go to places. And now what I encourage you to do is you need to find businesses that were similar to yours, study them for weeks and weeks, figure out what went wrong, call the founders and be like, why weren't you able to pull it off? And then come up with a strategy that's different and try that, right? Because there's no point for you to like launch a business that's just gonna repeat the same mistakes. A lot of it is preparation. You basically started a company because you felt like it was a good idea, but you have to do the work on like really figuring out like, how to actually make it happen. And it's not that simple. There's no simple recipe. Local is like notoriously difficult because it's super fragmented. Even Foursquare arguably has a hard time, right? Like it didn't fulfill its mission of becoming this like massive company because local is like really hard.
Yeah. So, I understand what you're saying, but again, getting that traction is requiring money, and so that's when you kind of need one to
Right.
the other.
But what investors want, they want you to come up with something unique and awesome that no one has thought of and do it on the cheap or on your own dime and show people. So for example, you can say, like if you showed up here and you said, Alex, I figured out a really cool growth hack for how to get, 100 people to go to 5 venues in New York. Let me tell you how it works. And then you would say, Alex, if investors give me $25,000, I now have a predictable way of replicating this to hundreds and hundreds of venues and tens of thousands of users. that's when you're going to get your investment, right? They want you to figure out like at least an inkling of what's going to be new. That's on you. When you need to pour gasoline on the fire, that's when the money will show up. They don't want to fund your experiments because you haven't said anything to them that they haven't heard before. So it's, again, it's like we're in the risk quadrant. And like, I don't want to risk my money. Like, what are you going to do, run Facebook ads? Like, a million other founders did that and yielded a zero, right? So that's why you have to, that's why like being unique and differentiated and coming up with something new and like something that actually would work. Like, you need to show a proof that it will work, that you have something unique.
You know, but I hear from so many people that you don't need to show monetization. You just have to have, if it's a B2C platform, you just need to show users and the money will come later. The monetizing will be, you don't have to worry about it.
Why don't you ask those people to fund you? Right? Like, I mean, they seem to be convinced.
Yeah, I've heard from so many people, and
Yeah.
it's strange because when I started to bring up the whole monetization, they said, don't go there, you don't need to. You need to just work on your getting users.
Look,
and getting them to love the
look,
platform and use
simplest,
it.
another simplest thing I can tell you, you should be your own toughest critic in the morning when you get up and look at the mirror, ask, is my business working? If the answer is no, you either have to stop or you have to figure out how to make it work. That's it. Like, the founders who raise capital the fastest are the ones who question everything way faster and way deeper than investors can question. And if you have experience in the space, the questioning becomes easy. If you don't have experience in the space, this questioning is super hard because you don't even know what to ask. But bottom line is it's on you to figure it out, and then investment comes. Yeah.
I want to know about accelerators and how their system works, and
Yep.
how do you think they would help startups and all that?
Do we still have time or are we out of time?
Piggybacking off of this, if anyone was late to today's session, Alex, our speaker today, is the managing director of Techstars, New York City.
So, okay, so real quick on the accelerators. So accelerators started about like 11 years ago with Y Combinator and Techstars were the first ones, and now there's like a ton of different accelerators. They sort of fall into different categories. So there's still Techstars, Y Combinator, 500 startups. Then there's also accelerators that are attached to universities, just like you guys have one here, Summer Launchpad. You also have accelerators that are vertically focused. So they would take companies only in healthcare, or companies specializing in e-commerce, or companies specializing in media. So the purpose of an accelerator, think of it as, it depends. Like they're kind of different. Accelerators are different from incubators. In an incubator, you basically have a bunch of people with an idea. And then you're kind of trying to make a product and try to figure out like what you're going to build. With accelerator, you already should have, theoretically, although again, there's no universals, you should have a ready product and an inkling of sales and a little bit of traction and maybe revenue or like beta customers. And then the purpose of the accelerator is basically to like help you get a lot more traction, typically in the form of revenue or in the form of customers, so that by the end of the program, you're able to raise more capital. So really most people go into an accelerator with the idea to raise capital, but better accelerators also help founders essentially like plug whatever holes exist in the business and really think about bigger picture vision, financial model, competitors, like pricing, sales tactics. So think of it as kind of like a mini MBA, although it's not necessarily content heavy, but more like tools and tactics heavy. So like specifically Techstars New York program that I've been running for the past like 3.5 or 4 years is just like super focused on helping founders, figure out what, how to acquire a lot more customers, how to grow super fast, so that by the end of the program, when investors show up, you're able to like secure an investment. That's kind of the short of the accelerators. Yep.
When you bring on new teams for new cohorts, what sort of funding do you see on average? What have people raised before coming to the program?
Post-program.
And before they come to you?
Before the program, So every accelerator is different. Like Techstars New York tends to go way earlier than other like Techstars programs. But on average, I would say we have plenty of companies that didn't raise anything, so we're the first check. We also have companies that raised, last class, a bunch of companies raised 300K before the program. We also sometimes take companies that raised $750 million. It happens for various reasons. Sometimes they just need a bit more like work and acceleration before they're ready to raise this next round, and we kind of figure out that we can help. We tend to not do as many of those. Some other accelerators do the opposite. They like companies with like who already raised a lot. In general, historically, our founders raised like $1.25 million or $1.5 million post program. However, this is no longer true in the last two cohorts. It's less. I would say the amount is more like $750 to $1 million because the environment is like super crappy right now for fundraising.
Why is that?
That's an interesting question. And so the short answer is Uber. Well, so here's what's happening right now. What's happening is that you have a ton of big companies like Uber, Airbnb, et cetera, that raised a ton of private capital, but they're not going public, and therefore there is no liquidity. So what's happening is basically a lot of private capital is locked in these super like big unicorns, and the money is locked there. So what's happening is there is a reverse domino effect all the way through the venture chain, where it's much harder to raise Series C, it's much harder to raise Series B, it's much harder to raise Series A. And what's happening to angel investors is you would hear like things like, I'm not liquid, or I'm not investing because I've made 30 investments, none of them returned me money, I'm out of money. And so a lot of angels disappeared, which causes in turn like situation where it's much harder for founders to raise capital. So that's basically what's happening. So the market is like much harder, and as a result, the bar for raising capital is so much higher. So angel investors take a lot more meetings with you, and they say no a lot more often than they used to. Yeah. Yep. Go ahead.
You mentioned that Snapchat got screwed in Series A. Could you talk more about that?
Oh, you can Google it. It's on it's on TechCrunch. So there is a fund. I'm gonna get it wrong, but you can Google it and on tech. Yeah, there's Lightspeed. Yeah, I remember the lights. Jeremy Liu actually, who screwed him, which is cool. He didn't invest in my company, but he's a cool dude. So basically, what happened was, he was the first institutional check into Snapchat. I think he put in like 400K, and not only he took a good chunk of the company, I don't remember a number, but he also got what's called super pro rata rights. So what that means is, and he also had a right of first refusal, which is pretty bad. So long story short, in human speak, he caused problems to Evan down the line. He essentially was able to block his future financings. Okay. Needless to say, Evan was not cool with that. So he like worked really hard to kick Jeremy out of the round and blah, 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 blah. Long story short, like Lightspeed made a killing on Snapchat IPO anyway, but it was like a pretty, it was like a pretty public, semi-ugly story on like TechCrunch. So you can Google it for like juicy details. This happens all the time. Yeah. Any other questions? Go ahead. Equity. Okay. In what sense?
I don't know. How do investors tie in with that?
So what's happening? Okay. So super high level. It's actually pretty straightforward. When you start a company, you have a pie. The pie is 100%, right? Let's say you have a single founder, then you own 100% of the company. Let's say you have two founders. You can do 50-50, you can do 70-30, you can do whatever makes sense, right? So you have two types of shares in companies. You have common shares, and then you have preferred shares. The idea is that investors get preferred stock. The reason they get preferred stock is because they want more rights than the founders. So let me explain it to you. If you and I started a company and you owned 60% and I owned 40%, any day, intuitively I work for you, and any day you can basically get rid of me. Like, hey, I vote, literally, for Alex no longer to be part of the company. You can kick me out, right? So companies literally have voting structure. So people who own stock are called shareholders, and they literally vote. So what happens is they vote much like you vote during the election. And whoever has more votes, like, logically would call the shots. So if we had a company with just common stock, then whoever has the most common share votes wins. Make sense so far? Okay. Preferred stock, which is what investors want, exists solely for the purpose of overriding this voting structure. So example, hey, so let's say we started a company, there were two of us, we were 50-50, then investor came along, we raised $1 million and we sold 20% of the company. So now investor owns 20% and we own, we both own like 40%, right? So what investor wants to make sure is that you and I don't just take off, or you and I don't do things that investors don't want us to do. So as an example, investor wants us to work for the company for a while and generate outcome that's not only meaningful for us, but also is meaningful for the investor. So example, somebody comes over and says, you know what, I want to buy this company for $2 million tomorrow, the day after the investment. So you and I, we say to each other, hey, listen, it's not actually a bad deal, right? Because each of us owns 40%. So 40% of 2 million is a good chunk of change. Why don't we call it a day, shake hands, and split the money, and we give the investor 20%. Obviously, this would be pretty unfair, but if there was no preferred stock, you and I literally could do that. So investors have preferred rights so that they can block this. So when we vote, if you and I vote to do that, a preferred investor would basically block it. So the whole point is that you have two classes of stock. You have common, which is what typically founders and employees get, and then you also have preferred stock, which is what investors want. Now, on top of it, it gets much more complicated because each subsequent investor wants new type of stock, and guess why?
To get better deal than the one before.
That's exactly right. So that they can actually have better rights than the previous investor. And so for example, if you raise Series Seed and Series A investor wants better rights. So let me give you an example of a right that I would want as a Series A investor. Well, if we sell the company, I want to get paid first, right? Because why not? I don't want to get paid last. I don't want to get paid in the middle. I want to get paid first. So literally, Series A investor would ask to be paid first. And then there's like a bunch of other things. And it depends. Some investors agree that all preferred investors have equal rights. Some investors insist on having like better rights. And all of it is a function of how well the company is doing. So example, Mark Zuckerberg and Facebook, he actually had something that's called founder preferred shares. So because Facebook was such an astronomically amazing company, he was able to create a class of stock that allowed him to block all of the preferred investors. And so founders who are enormously successful like him, and Evan at Snapchat did that after he got screwed, in that example that we talked about, like after that, he also created the founder preferred stock. But, more typical scenario is, let's say you're raising Series A. If you only have one firm that's giving you a term sheet, you don't have much bargaining power. You kind of have to take an investment. You don't really have a ton of choices. So you agree to whatever terms people give. And they know when you don't have a choice. So they can squeeze you. However, If you have multiple firms that are interested in your company, you can let them know, and now they have to bid. So now you can basically say, hey, actually, I don't agree to this term. And so as a result, you can potentially like end up with a better deal. But long story short, equity is basically like plays out in a very serious way in most companies in the end. So if your company is super successful when it's sold, then each share of the company is going to be worth something. So if you sell a company for, and I'm kind of simplifying for the purpose of this, but if you sell a company for $100 million and you own 10% of that company, you will get 10 million, right? So essentially, all of it starts with founders owning everything, and as company grows, founders own less and less, investors own more and more, but even the small chunk that founders end up owning in the end, if you build a really big business, is worth like millions and tens of millions of dollars. Yep.
So those preferred shareholders, they only have the right to block, but not raising,
Not what?
not making a decision, right?
Well, so there's like dozens and dozens of rights, right? So yes, correct. They can fire you. They can fire a CEO, right? Like they can do different things. It happens all the time. There's like a lot of different rights. They come in different forms. They have different purposes. They're typically lawyery, but the most common thing is, they want to make sure that, for example, it's really important for larger firms to have what's called a pro rata right. And the reason it's important goes back to what we talked about earlier about returning the fund before you can get paid. So as an example, if I was your Series A investor and I bought 20% of the company, when your Series B happens, I want to keep 20%. I'm not willing to be reduced to 15%. Because think about it, in the very end of this runway, when you are a $1 billion company, if I own 15%, I get less than if I own 20%. So the purpose of the pro rata is to keep as much ownership as possible until the finish line. So that's a very common thing that people fight over, and it's very significant. It's like do or die for venture capitalists, because if they don't get it, a lot of times they don't make money, and it sounds crazy, but it's totally true. Then there is another kind of right, for example, right of first refusal. This is pretty common when a larger fund gives you money for seed capital. So how it works is they would say to you, hey, I'm happy to give you $500K now. That's not really interesting to me, because what I really want to give you is I want to give you $3 or $5 million when you're ready for Series A. Now I'm going to give you $500K now, but what I want is I want to have the first look at your Series A. So what that means is you can't really raise Series A from another firm without telling me, because I may want to do your Series A. So that's another kind of right that preferred stock may have. And like there's dozens and dozens of other rights. If you want to go deep on this, there is a book called Venture Deals by Brad Feld and David Cohen that goes, it's on the shelf, so you guys, it's called Venture Deals. You can nerd out on all of this stuff. It's super complicated, basically, and like it requires, I still feel like I only understand like 85% of it, and I feel like I do it all day long. So like it takes multiple like passes, and it's highly nuanced. Yeah, cool. Any other questions? Go ahead.
When you mentioned earlier, like an accelerator will help you to get that growth, what kind of help would be given? Like, would it just be strategy based or like, I don't know?
Right. I mean, it depends on the kind of accelerator and the kind of a company, but high level, people would mostly work with you on, like, for example, if you're a B2B company, the help would be twofold. Threefold. Fine-tune your like pricing, make sure it makes sense. 2, introduce you to like a ton of potential customers. And 3, fine-tune your sales funnel, right? So essentially, it's all focused on making sure that you can sell the product. But to sell the product, you need to make sure that like your pricing is correct, that you have enough potential leads, and that you can convert the leads. So that would be an example. We also, like Techstars New York, we're super nerdy around marketing and user acquisition. So we have like a ton of workshops on like, okay, let's figure out like what are all the channels for acquiring customers? Like what's the cost of acquiring customer through every channel? What's the lifetime value of your customer? So really it's all, like all the help is focused on like, how can we get more revenue, or like how can we get more customers?
How about B2C?
For B2C, it would be basically understanding the, well, it's similar. You're trying to understand your acquisition channels and where do you get customers. I mean, like that's the question, right? Like how do you find customers? So, for example, if you're a B2C startup that makes no money, you can't afford to run ads. So that creates a problem, right? So then the question is like, how do you circumvent this problem? Well, you kind of have to go and maybe acquire your first 1,000 customers manually. That could be painful, but if you're in Techstars and we have 100 companies just in New York, and we have 1,000 companies in the Techstars network, maybe we can write an email and say to people, hey, there's this cool thing, maybe you should check it out. And then, you know, like trying to figure out different ways of acquiring customers depending on the type of your business. Yeah.
For raising capital from friends and family, what's like a standard term? Like, is it term
Yeah.
kind of thing?
I'm really glad you asked me this because I feel like 90% of the companies get it wrong. So here's what founders get really wrong. They take money from friends and family on the ridiculously low terms. So as an example, I've seen founders, they're like, yeah, I took 100K and like I gave them 10% of my company. That's bad because honestly, your friends and family isn't in this to make money. They're in this to give you a vote of confidence. They're like, you know, Mom, Dad, I got this crazy idea. I'm dying to start a company. All right, our child gone nuts, but okay, whatever, we'll bankroll it, right? Like, so we'll give you 10K. They don't need to own a ton of your company. They're not professional angel investors. So the conversation that I would have is I would either do it on an uncapped note or on a note, just basically just do it like as a loan. A lot of times it just makes sense to return it because ultimately it's not as meaningful. Now, if they're discerning people, like if they understand startups and if they really want to bargain with you, that's different. But really make sure you don't give out a ton of your company to friends and family because that kind of creates problems down the line. I mean, I would recommend like an uncapped note or like a promise that it will convert at the price of whatever next round that's going to happen. Yeah.
Then if, let's say, my family invests me on about like 100K and I end up getting the VC money
Yep.
of like 1 million.
Mm-hmm.
Is it possible for me to pay out of that 1
Yeah,
million?
you can just pay it back.
Oh, and that's
Yeah.
fine for...
They'll be totally fine.
Oh.
Yeah. All right.
Say something kind of different from I guess the other talks, but I was wondering, are there any social impact metric funds or the metrics that you measure simply like in a weird way utilities are just happiness? For instance, let's
Yeah.
say you have a public park, you get $1 million funded, and you basically rate it by, I felt a 1 on a healthy scale before, now it's a 10. And you get the companies to sponsor the logo and the bars, and then therefore people can see that when people actually invest into that, since they know like actual rate of return, it's more just a social utility.
Okay, so it's more like charity?
More like charities, but we don't call it that.
Why not?
Just because sometimes, as far as like,
We gotta call it what it is, right? Like,
call it what it is, but like just to, I guess, have a little bit of pride when you see
well, the reason that I'm asking is because there's two things that are happening. There's investment. There's actually like a pretty big rise of investment investors who want to invest for public good. So that's actually a thing, but it's a for-profit, still for-profit, but kind of like for public good. You don't necessarily have to be a B Corp. You just need to kind of have a good mission. So a fund in New York that started, I think, like 5 years ago, called Collaborative Fund, that's focused on companies that are good for the planet. And in general, there's a rise of the sort of specifically like family offices and venture funds that want to invest in companies that are like generating some kind of public good, at least not harmful. That's different from nonprofits and charities, because nonprofits and charities are not expected to generate returns. They're like one way, dollars go here, and then sure there's good created, but there's no flow of money back to the investors. Yep.
The first and collaborative fund and things like that, how do they usually make the returns?
Say it again?
How do they usually make the returns of for-profit public companies?
Because they're for profit, right? So by definition, you know, like, you know, we invested in a company that basically it's in the sustainability space, and what they do is they take fly larvae, which is like flies, and they like dry them up, and they feed that to like, you know, chickens and fish. And so that's an example of a company that's like good for the planet. Or there's another company that invented new way to de-ice airplanes that like 1,000 times cheaper and like more ecologically friendly. So there's you know, but they're still for profit, and investors will only invest in them if they see a return in the end. Yeah, I feel like what you described is more of a nonprofit. Yeah. Yep.
So I'm from Malaysia. If let's say I have an idea that I want to do in Southeast Asia, would accelerators or VCs still be adverse to investing in this kind of geography?
Depends. Mostly they won't. They would probably not want to do it unless you have astronomical traction and they can't resist and they feel like it's an amazing idea. Most investors will tell you, hey, I can't help you. You know, my entire network in New York, you're asking me for money, I don't know anything about Malaysia, it seems great, but like no idea. That's like a semi-BS answer, because if there is like a really massive business and you're kind of getting it off the ground, I feel like people would, you know, potentially would do it. But as a rule, remember what I said, angels typically like to invest locally. This is a very non-local type of thing. So I feel like most people will say no to you unless there's something super compelling and unique.
Kind of along that same line, do you think that having founders who aren't American is a problem for VCs?
I don't know. Well, I'm not American or weren't born here.
I'd say not American in the sense that like you're here on maybe a student visa, or
Right.
You don't have.
Got it. You should just say that, because otherwise it's kind of sounds a little weird. But like, I mean, I wasn't born here and I feel like I'm an American. But yes, because increasingly with like this administration, you can get booted out, sounds like any minute. So there's like increasing risk compared to like what it used to be. Historically, it was never an issue. Again, everything is a function of like your traction, right? If you have astronomical traction, they'll be like, we're willing to take this risk. Because think about this, it's a roll of the dice, everything. So is it worth the risk? Like, if you have great business and, you know, one founder could be deported, willing to take that risk. Again, if it's the only founder or it's like critical founder, kind of harder, but there's always risk reward and people will figure it out. Yep.
We have time for one or two questions.
What about a company or a startup based in healthcare where the product has the potential to work but depends on FDA approval of clinical trials passing?
Yeah.
How do you make a venture capitalist or an Asian investor invest in you?
It's harder, right? Like it's sort of like a hardware company or medical device or something that requires FDA approval. Anything that's hurdle like means more scrutiny, harder to raise capital. As a first-time founder will be that much harder because they don't know if you can even get the FDA approval. Like, do you understand what it takes to get an FDA approval? So now that said, there's a Blueprint Health Accelerator in New York, and Techstars New York, my program, also does does healthcare companies. I don't feel like it's insurmountable barrier, it's just another question mark. But you can definitely raise capital. You just need to demonstrate fluency around understanding what it's going to take for you to get that approval. Yeah. Cool. All right. I feel
Alex, thank you so much.
like my
for being
pleasure.
here.
Thanks for joining me.